Everyone's focused on getting diversified, everyone's buying index funds, and everyone thinks they own the market. But they're missing what's really happening under the hood of the world's most popular stock market index. Welcome to the Dean's List, everyone. I'm Dean Lolkin, investing veteran and private credit CEO, here to help you grow your wealth. Today, I'm going to show you 3 shocking truths about the S&P 500 index. They're going to completely change how you think about what you own. First, we'll talk about why 500 stocks are really an illusion. Just 25 companies control that entire index. Then we'll talk about the hidden tech exposure that's way bigger than you think. And finally, what happens when you equal weight that index? And why does that matter for your money? Make sure to watch all 3 parts. The concentration will shock you, and almost nobody understands what they really own here in 2025. What if I told you when you invest in the S&P 500 index, half of your money goes to just 25 stocks? Let that sink in. Not 100, not 50, just 25, 5% of the entire index. This is due to the cap-weighted nature of the index. The bigger a company's size or market capitalization, the greater its weight. Here are the 25 stocks that make up 50% or a little more of the entire index. Take a good look at them. I'm sure you recognize some of these names, or most of them, but here's something even more shocking. Apple. Apple alone has the same weight as the bottom 213 members of the S&P 500 index combined. We've never seen concentration like this before. Not during the dot-com bubble when I was in college. Never. But it gets more interesting when you look at what these companies actually do. Everyone knows the technology sector is a massive part of the S&P 500 index, but you don't know the real story. The official technology sector is just the tip of the iceberg. Look at these companies that are technically not counted as tech. Google, Meta, Amazon, communications, consumer discretionary. Tesla and Netflix, that's a consumer discretionary and a communications company. When you add these tech companies back where they belong, into the tech sector, the true technology concentration is staggering. The official technology sector weight is 31% today. But you add in those hidden tech companies that amount to about 16% of the index, and your true tech exposure becomes, 37%. Should this worry you? Of course, that's what you want to know. It depends on your age, your goals, and your risk tolerance. I expect the trends from the past few years to continue in 2025, but let's talk about how we could go about reducing this concentration if we so desired. Here's what happens when every stock in the S&P 500 gets the same weight. We already know that the top 25 represent about 50% of the index, and Apple has the same weight as 213 of the smallest companies in the S&P 500. And tech is 37%. Now, with an equal weight S&P 500, guess what? Every stock is just 0.2%, 1 divided by 500. There is no mega cap dominance, and technology as a sector drops to about 14%. When you add back Tesla, Amazon, Google, and Meta, you're still not even at 20% of the entire index. Look how differently the market really looks when every company gets an equal share. This is not about right or wrong. It's about understanding what you own. Why does it matter? Because when concentration changes, and it always does eventually, you don't want to be caught believing in a diversification delusion. Lots of people think they need to use an index like the Russell 2000 or some other small cap benchmark to gain exposure to smaller companies. I would argue that's a waste of time before you use an ETF like ticker RSP from Invesco. It's got a reasonable 0.2% expense ratio, and you get exposure to an equal weight S&P 500 index. By the way, for all you risk takers out there, Direxion has an equal weight NASDAQ 100 product, ticker QQQE. Here's what you need to understand about the S&P 500 index in 2025. First, concentration is at historic highs. 25 companies control half your investment. It's the most important index on earth. Second, technology dominance is even bigger than the official numbers suggest, when you count tech hiding in the other sectors. Third, the equal weight view shows us just how skewed things have become. Is this concentration bad? Not necessarily. These companies are dominant for a reason. They're incredibly profitable, growing fast and reshaping the global economy. But you need to know what you actually own, because when things change, and they always do, awareness will matter more than your predictions. This is the Dean's List, where we expose the market patterns nobody else is talking about. If this analysis opened your eyes, and I hope it did, make sure to follow for more insights. Hit the like button if you learned something new, and comment below what market myth or quirk you want me to break down next. I'm Dean Lolkin, and I'll see you on the next one.